The broadcast is now starting. All attendees are in listen-only mode.
Okay, well, good afternoon, good evening, everyone. My name is Mean McHale. I'm the current president of the International Model Investment Club. I'd like to invite you and welcome you to our meeting this evening for June 2022. We are an international investment club, and as you can see on your screen, you should be able to see links to our different social medias and accounts. We were founded in May of 2016. We have a very international club membership that's open to the public. Guests can attend and can potentially join our meetings. We host monthly meetings on the third Monday of every month, with the exception of December, where we host it on the second Monday. To be clear, in this club, we use hypothetical money and not our real funds. We invest in real companies and we track the dollar amounts in real time, but this allows us to be more creative and to track more companies. So this is primarily a learning club that's meant to give you more familiarity with investments and the better investment principles and the use of the stock selection guide and the other tools that are available to us. All our meetings are held online, and that allows us to have guests and members from around the globe. Currently, we have 13 members. Our members are located in the United States, Canada, China, and Singapore. And so, pardon me. So as you'll see in if you see on the dashboard, you should be able to see a copy of tonight's agenda under the handout section, as well as some FAQs about our club and things that guests might be interested in noting. All guests and visitors will be muted for the duration of the meeting. Please feel free to post your questions in the question tab on the dashboard, and we will definitely get to them towards the end of our meeting, the substantive portion of our meeting. And at the end of that stock presentation, all of the guests and visitors will be unmuted so that they can ask their questions, concerns, and engage in the discussion. Here, and so we do have a disclaimer that this information is presented for educational purposes only and is not intended to provide recommendations to buy or sell securities that are referenced in today's meeting. The views that are expressed are those of the participants only and do not necessarily reflect those of BetterInvesting. We do recommend and urge you to conduct your own research and analysis before making any investment decisions. And please be mindful of the fact that some of these securities that are discussed tonight may be held by any member of the presenters or of our membership in their own personal portfolios. This presentation may contain images of websites, products, services, analysis that are not endorsed by BetterInvesting or the presenters. And these meetings are recorded and will be posted on our YouTube channel within a few days of the meeting. So for reference.
Okay.
I think we can, at this point, move on to the agenda, I think, for this evening. Thank you, Joanne. And so today we will have both an education topic and a stock study tonight. So we'll do a portfolio review and an education topic. So we won't have any quarterly reports or annual reports on any of our current holdings this evening. And so at that point, I'll pass it on to our treasurer, Reddy, for his report, if Reddy is available. And I think I see him here.
Yeah, how do I take the screen, John?
Yep, sorry, Reddy. I'm just trying to send that to you right now.
I can. Do you want me to make ready the presentation?
You should have the invitation now.
Oh, okay. Okay, I'll present the treasurer's report. This month it's somewhat simpler because there are not any buys and sells which are actually passed. The current today's position shows I deposited $1,200 for 12 members. I did not deposit for Mahesh. I think he is withdrew as of last meeting date, and hence I paid out $769 for his share, including the 2 days deposit. The balance is 3,800. So potentially we can buy some stock today, or redo the last month's buys and make sure all the members are aware of the motions, so they vote and then they can pass. Next, this is the heat map position. You can see again our vertex is a little larger, and couple of them are really short, but we had to relook at in light of the recent downtrend, especially Amazon and Robot and LGIH. I think Joanne or somebody added this one, so I updated this slide from last month. Schwab is the biggest gainer, and Amazon. By the way, there is a feature split adjustments feature on the iClub website. I use that and updated Amazon 20-to-1 split. Still, we lost about $1,300 or 34%, 1/3 of it. And other next higher losers are iRobot and LGI Homes. I don't know why these home stocks are going down, including this one, DR Horton and Century Communities. They are all going down. And this is the portfolio gain loss picture. You can see a lot of reds. Reds are increasing, and we had to watch some of these reds with large numbers for possible sell candidates. And this is the top performance compared to benchmark indices. You can see that this year we are not doing well, but we are doing only slightly worse than the benchmark indices like Vanguard Total Index and Vanguard 500 Index, which all went down by 25 to 30%. These are the company, all the companies that we have, and you can see that the iRobot is a small, and we can invest some. Or a robot is not going anywhere. I personally have this too, but not going anywhere. I do not know what the basic problem is. Either we should sell it or review it more thoroughly. Company diversification, we have a little less on the large companies. We have less, and I don't know whether we can shift some money from mid cap to large. I don't know, but I updated these numbers. I noticed that last month's slides, these are rounded to the nearest whole number, approximate numbers. And sector diversification, again, we have a large percentage in health and communication, and others are okay. There are 15%, 7%. The health is largest. Communication is next largest. We may think about balancing these in the future. And this is the last slide, industries. Again, the biotech industry, because of the vertex, is a large amount. It's the largest. And we can look at either these with smaller fraction, either get out of them or buy more of this because we have cash. Okay, any questions?
That's great. Thanks.
The two motions that Joanne indicated, they're not passed, and that's the second time. I think we should stress the fact to all the members that please vote within some 2 or 3 days, whatever it is, so that we can clearly identify whether the motions are passed or not passed.
Okay. Thank you, Reddy. Just a reminder, last month we had to, there were 2 motions that didn't pass because we didn't have a simple majority required to pass the motion. I'll leave the, I'll leave it open longer. It was open till just the following day, but maybe I'll give it a couple days to for everyone to vote.
I think, Joanne, a reminder email may help.
Okay.
Help.
So we had a motion to buy $1,000 of Google and a motion to buy $1,000 of FAF. And they didn't pass. Okay, so actually, Mina, we do have, 2 stock reports. I'm thinking, Reddy, we are having a cannabis. Wait, Jay, is the cannabis person speaking, giving an education topic next month?
Yes,
Okay,
as
so maybe,
scheduled.
Reddy, that would be a good time to present your stock and give you time to research that class action lawsuit. Is that okay?
Okay.
Are you
Yeah.
okay with that?
Yeah, I just briefly read the lawsuit. Lawsuit is why did they choose to go read, and why is this coming? It has been read for 4 years.
Yeah, well, okay, so we'll save that for you to present next month. Jane, did you want to do your Vertex or do the education piece first?
I can do the education piece
Okay.
first.
So I'm going to make you presenter.
Okay. All right. Can you see my screen now? Can you see my screen?
Yes, I muted.
Yes.
Okay. All right. Good evening. Yes. Yes. I just want to present Berkshire Hathaway 2021 letter that was issued back in February. And this is the first time I read the letter. This year's letter, it's about 11 pages, as you can see. And it's relatively short, but again, it still contains a lot of valuable lessons that we can learn from. And in fact, this is the first time I'm so happy that I have the opportunity to go through the letter thoroughly this time because I have to present it. But this is a really, I think this is a very good piece of information that we should get on and try to read every year when they issue. So maybe present. So today I will go through the main points that are in the letters I extracted. I would like to share with you, and also the implications. And most of all, I like to share the lessons I can learn from them. And you are more than welcome to ask any questions. I hope this is a session that is interactive, and I'm not the one to just teach or share. I just want you to all kind of go along with me and just okay. Warren Buffett and Charlie and Warren, I mean, they have been doing this every year except for a couple years they didn't do it together, and this year they came along again, and I was impressed with how energetic they are and how passionate they are about their company, about the investments. And basically Warren and Charlie, they emphasize again this year, they always look for meaningful investments, and what they define meaningful investments are businesses with durable economic advantages, plus good management, first-class CEOs. This is what they what they define. And this is corresponding with our philosophy at BetterInvesting. We always review the management, see how well they do. They invest, they manage their company, which is reflected in the financial results. And we also look at different factors, including mold and every other things. So this is really, I mean, I think BetterInvesting really follow Warren Buffett's value investing principles. So Buffett and Munger, they also said they are business pickers. Apparently, they are not stock pickers because they always look at the long-term perspective or long-term potential of the companies they are investing. So they believe if you pick the right business at the right and go in and buy in at the right price, basically the stock price will take care of itself. So you don't have to time the market, and it's a fruitful, endeavor to time the market, because there's no way that you know how the market will go. And as you can experience this past few months, it just goes swing, from one end to the other, and just no way we can time. But as long as you are confident that the companies you are investing in are good companies, and when you purchase in, you purchase at a reasonable price, or hopefully lower than reasonable prices, then you have a very wide margin of safety. Then you don't have to worry too much about it, because eventually the stock price will come back again. So I think you all know Berkshire and Hathaway. They are two textile companies, and they merged in 1965. And when before Warren came along, the company suffered great loss for about 9 years after the merger. And because, as you know, at the time, textile company is not doing well, especially BH. They are in the north, and their labor cost is much higher than the south, and they are facing foreign competition, and also all the factors are going against them. But they continue to invest and hoping that the situation will get better. And each year, seemed to get better, but in fact they did not. They did not consider the equipment write-off they are taking in. They write off directly as a reduction to capital, so it's not reflected in as part of the income. If they did reflect as part of the loss in the income statement, then they have loss all along. But somehow they managed to have marginal profits, for a few years during that 9-year period. So anyway, Warren took on and invested in this company, and he started using the available cash, and also he started investing in an insurance company, which I will go over later. So he started doing that, and he's getting a lot of float, which I will define later. Float is the insurance premiums he's getting from the insurance company. So he's using those floats to invest in quality company, and he's such a genius. So the companies he picked up most of them have long-term growth potential. So he managed to reap very high returns from them. So Warren, again, re-emphasize, they always reinvest their earnings. So and he believed in the power. We all believe the power of compounding interest. So BH, Warren believed that why this company is so prosperous, it's all because it's operating in America, and because of that, they are more than happy to pay tons of taxes to the U.S. government. So we just mentioned Warren. BH has basically in the letter, it mentioned that BH has big 4 giants one is a group of insurance companies they are owning, and the second one is Apple. And even though it only it constitutes about 5%, a little bit more than 5% of Apple company, but it's a big share. And also BNSF, it's a railroad company, and BHE is it's an energy company. So basically, these are the four pillars of BH. So BH acquired National Indemnity, the first insurance company they have in their portfolio, back in 1967, and they pay for about 8.6 million, and BH own 100% of all their insurance companies, and this group of insurance companies contribute about 150 billion in float. Float, as I mentioned earlier, they are insurance premiums they collect from the insurers, and they use these are free money. They don't have to pay for any interest. These are the free money. So until anybody make a claim on their insurance, basically these are free cash. And so even though before the year end, this flow is not money belonging to them, but they can have all the right to use it. And the approach Warren and Charlie took is they heavily invest in all equities, mostly equities in their portfolio. And this is hard to duplicate just because other insurance company, they possibly cannot do that because they have regulatory and credit rating constraints. So this is one of the kind. BH is one of the kind company. So BH is committed, to handling catastrophic, events. So they insure those events, and they did experience a couple lost years, but it's not too bad. So over 1967 until now is about 55 years. So only 2 years they suffer loss. So all the other 53 years they have gain, they have profits. And BH's huge value creation in insurance, I guess they attribute that to their hiring of their vice chairman of the insurance operation, Ajit Jain. I believe Ajit is it's Ivy League graduate, and he's from India, and he's brilliant. And I have heard him talk a few times. He's just great, and I think Warren thinks very highly of him. And he was hired about 37 years ago, and he did not have any insurance company's experience. He did not have any experience in insurance, but then the person is right, and he could do the right job, and the facts prove so. So the objective for Warren and Charlie is to invest the floats from the company in all equities. That's their goal. But then a lot of time, as you know, they keep a lot of cash in their portfolio just because they don't have good enough companies to invest. So currently, at the end of 2021, about 80% are in equities, and the other 20% are in cash. So even though initially both of them pledged that they would keep at least 30 billion cash in their portfolio, but they ended up with 144 billion at the end of last year because they just cannot find good enough company to invest for the long term. So BH has repurchased because of the fact that they didn't have any good company to invest, and they feel that the company itself is a great company to invest. So they have been repurchasing their own shares. So they have spent about 52 billion in 2020 and 2021, these 2 years, and another 1.2 billion in in February 2022. And the reason they do that is because they want to get the return back to the shareholders. Any questions so far? Okay, so I'll continue with it. All right, so Warren believed that the stock repurchase is a way of returning to the shareholder. So at the right share price versus value, then Warren will purchase back the BH shares. And when you purchase back the share, the EPS naturally grows. Why? Because the outstanding shares decline. So the earnings divided by the outstanding share, the EPS naturally grows. So if the P/E ratio remains constant, if the multiple does not shrink, does not contract, remains constant, then the stock price should climb, should increase. So the shareholder value increases. So stock buyback is the simplest, according to Warren, simplest and most sure way to increase shareholder value. So what do you think? I mean, stock buyback. Do you agree with Warren and Charlie? Okay. So at the end of 2021, Apple's share, the ownership in Apple company rose to 5.55% from originally 5.39%. But in fact, they didn't invest any more money into the company. And it's all because Apple's CEO, Tim Cook, purchased Warren's annual letter 2021. So measure of retained earnings. As you know, when a company owns shares in another company, if it's less than 20%, then they don't account for the share of the income of the investee. They only account for the dividends they receive from the invested companies. So let's see. So at the end of last year, 2021, the marketable stocks owned by BH are about 350 billion, and they are composed of this. So Apple is about, as we saw earlier, it's about 5.6, and American Express company have been invested by BH for the longest time, and also all the Coca-Cola, these are old timers and all this. So about 350 billion was invested in all these companies. So from the accounting perspective, you know, this company's share of income is not booked on the BH books. So BH only account for dividends in their income statement for this company, but these companies are less than 20% of ownership. So they don't use accounting equity method to account for the share of their earnings. But in fact, BH has proportionate share in their earnings, in their long-term prosperity. So for example, BH received just now, Apple, right? They own about 5.6%. So BH received dividends for that year, last year, about 800 million, 785 million. But in fact, they actually entitled to their 5.6 share of Apple's earning which is a staggering 5.6 billion. So of course you will say, oh, all these are reflected in the stock price for Apple. Yes, indeed it may, but it may not. But they do have this share of income in their invested company. So we saw this earlier. So Warren and Charlie, they maintain a well-balanced and diversified portfolio. So just now we said there are 4 pillars. Apple is one, and Burlington Northern Santa Fe, a railway company, is the second one, BNSF, and it's 100% owned by BH. And also they own other infrastructure assets like Berkshire Well, Hathaway Energy, BHE. They own about 91%, and they also invest in BH Renewables Energy Company. So BH owns and operates more infrastructure assets than financial assets, because including myself, I always thought they own a lot of different kinds of assets, but I never knew they are heavily weighted on infrastructure assets. So besides what we just went through, as you know, Warren and Charlie, they always share their life experience and their advice, besides business, and a lot of life advice. And this year they share with the university students, because one of the audience who raised question are university students. So they advise them to seek employment in fields you are passionate about and with people you like. It's just that you don't need the money, but you just choose the people you want to work with, and then make sure that once you are in the team of good people and passionate people, then you try to bring value to your customers and invest not only in great companies at a fair price, but also invest in yourself. So this is the advice. And do not give up on your quest for such a fulfilling career. And I call it calling, because I believe God created everybody, and there's a calling, there's a life mission for everybody to fulfill. So we just need to find out what this calling is and try to fulfill it, and we will live a fulfilled life as a result. The lesson I learned from reviewing 2021 BH letter is that we always, when we invest, we always have a long-term growth potential of the company in mind. So we are not timing the market. We are not trying to just get short-term return. And if we invest anything, we make sure that this is a company that is worth investing in on a long-term basis. So we need to make sure that the company, the invested company, has long-term economic advantages and also have excellent management to manage the company. And we try to reinvest our earnings or our income, our salaries, and make use of the power of compounding interest based on continued. And also, once we invest, we don't just just hold, buy and hold. We need to, just like what our club is doing, we continuously monitor the financial performance of these invested companies and make sure that they are doing as well as we expect. And if they don't, we give some time to observe. And if still for a few quarters, if the company still doesn't do well, then we shall consider why, whether the factors are affecting whether the factors affecting their performance are temporary and or a permanent, and we decide whether we should divest. So I think our club is doing exactly, Warren advised us to do, that we need to have a very well diversified portfolio. So Reddy is keeping track of our portfolio and make sure that we have the right portion of small, medium, and big, large companies, and also are in different type of industries or sectors. So next month, Ela and Christopher and I will do a stock study. So we will try to follow the guidelines in selecting our stock for study. And then once you have a portfolio, then it's always, I mean, even if we don't have a new company to invest, we can look at the current companies in our portfolio and try to rebalance. For example, Vertex is doing really well, and perhaps it has achieved the price, the target price that we are hoping to achieve, and we can sell some of it and rebalance it to some other companies, quality companies, of course, within our portfolio. And we also can invest in new companies if we can identify them. And the last point, is it last? No, the second last point is about cash position. This is a lesson I have to learn, because I seldom keep cash in my portfolio, because I fully invest, almost 100% fully invest all my cash. So actually in the uncertain time, like this, in fact, we should try to keep a bigger position in cash. And it doesn't matter how the market goes, we still have some bullets to use. When the market goes down, we can purchase more stocks, great stocks at a great price. So, but unfortunately, I haven't adhered to this principle. So this is something I have to learn. And then the last point is, we should all pursue our quest for fulfilling journey of investing, because this is what we do as a club. And I'm so blessed to be in the club and to learn along with all my team members who are very passionate about investing and keeping their own portfolio and learning together with others. Thank you. Any question?
Hi, Jane. Thanks for the presentation. Did you, you said that Apple 5.55%, I believe, or 5.5%? Is that
Yeah.
Berkshire owns 5.5% of all the Apple stock, right?
Yeah, 4.6%. Yes.
Oh, okay. How much of the percentage of their portfolio is Apple? Berkshire's portfolio is Apple. Do you know? Did you say?
As you can see, if you look at the market value, you divide it by 350, it's about half.
Okay,
half
got
of this 350.
Got it. Thank you.
Less than half. Less than half. Yeah. So I think I learned a few things, and I don't know, after you hear what I present, perhaps you have more insights, and these are the lessons I learned. And I do know about stock buyback, and I do know the principles, and I do know about the importance of keeping cash, but then I just have to learn to implement or to execute in my investment. I have to discipline myself and do it. So reading this type of letters, very you learn valuable lessons, but we still have to execute I have to execute in my journey, in my investment journey.
Jane, this is Joanne.
Yes.
I have a question. Isn't having 50% of your portfolio in one stock dangerous?
Certainly, but I think they probably, no, this is not the whole thing, remember? They still have other companies. They have a bunch of insurance companies.
Oh, okay. So this is just
right?
their equity
Yes, there's only the equity portion. I have to check how much percentage of this portion. But they have a bunch of other companies, including insurance company, infrastructure companies that we went through. So there are 4 pillars
Okay.
of the.
Why do they believe in Apple so much?
That's one question people ask, because Warren did mention that he doesn't invest in technology company, but I guess Apple is not pure technology company. So I think he really liked Tim Cook. In the letter, he highly recommend. I mean, he highly praised Tim.
Okay, interesting. Thank you.
Yeah, sure.
Are there any other questions for Jane?
Yep.
Did you want to do your Vertex? Do we have time, John, to do Vertex?
Not on the agenda, I don't think, but I don't know how long we're going to take with our presentation. Is it going to be 55 minutes or is it going to be less? Because
well, should we go through our presentation? We'll do our stock study first, and then if we have time, because Jane didn't get a chance to do her stock last month.
Got it.
Yeah,
yeah I get
it's
it.
okay. Yeah, we can do the other things first.
Okay.
Perfect.
All right, I'll take the screen.
Okay.
Let's see, right. Mina, did you want to go through the initial?
Right. So, absolutely, yeah. So so John, Piero, Joanne, and I, we worked together to do a portfolio review. So this would be a financial sector challenge. Essentially, we've decided to take a look at some of the potential sell candidates in our portfolio, compare them to a potential new purchase, and see if we can better manage our portfolio. We discussed in previous meetings the need to trim down some of our holdings to ensure that we have enough time and attention to each individual holding, and to make our portfolio match the membership size. And the reason why we're doing portfolio reviews is we're looking to hopefully new acquisitions or new companies, new holdings would replace underperforming holdings, and we can refresh the pot by selling those underperforming companies or those we don't find to have long-term good value according to the better investing principles, and replace them companies that meet those standards. So we picked this study to challenge FAF. It went according to, we did the stock selection guide. It found that, or stock screening guide, pardon me, found it to be a candidate under the sell checklist for potential examination. We found a competitor. And we also are examining iRobot this evening for 2 main reasons, especially, its recent performance in the market for the past 6 months or so has led some questions about its long-term viability, as well as its it compromises a very small portion of our portfolio, I believe 1.9%. And so we, as a club, if we are going to follow those better investing principles, we have to either make sure all our holdings meet the minimum threshold of 5% of our portfolio, or we discard those. So for those reasons, we'll move on to, I guess, the screening.
You want me to go on?
Yeah, please, if you don't mind at this point.
So I'm going to just go over how we came up with our initial stock challenge. We've used the BI screener, which is on the left here. So we put in that we wanted to target, based on our portfolio, we want to target a small company. We wanted our return on equity trend to be up, and we wanted all our Morningstar grades to be greater or equal to C. So the only the ones that we screened for, the property and casualty financial services, came up with Kinsale being the most promising. looking, so we decided to use that and then target FAF as a challenge. Okay, so I'm going to do a brief overview of the property and casualty industry. So the conditions are fairly good in the broader insurance market at present. Insurers keep the lion's share of their investment portfolios in bonds. Federal Reserve has begun to raise rates to combat inflation. Most insurers will continue to enjoy year-over-year earnings gains at least through 2023. However, investors should be mindful of industry capacity levels. Excess supply can foreshadow a secular downturn. So what that means is that secular is like the industry, and it's a long-term downturn, short-term downturn. And that also companies that are well reserved tend to outperform during periods of higher catastrophe activity. So that's the kind of company that you want to look for, is companies that have good reserves. So what is property and casualty insurance? It's where companies provide coverage on assets as well as liability insurance for accidents, injuries, and damage to others or their belongings. Property and casualty insurers cover a number of things, including auto insurance, home insurance, marine insurance, and professional liability insurance. Customers pay property and casualty insurers an insurance premium for their desired coverage. So as a subset of property and casualty, there's excess and surplus insurance, what's commonly known as ENS. So this insurance coverage serves customers who are unable to obtain coverage in the standard market. So these would be people like in high flood zones, high fire properties. So it enables customers to obtain casualty or property insurance coverage via an insurance market that is regulated by their respective state. It also has the ability to effectively adapt to changing market conditions, as well as consumer and commercial firm preferences. This segment of insurance is unlike standard insurance for the usual risks that employ pre-approved policies and pre-approved rates. So just showing the state of the E&S market. So this graph shows how the E&S market has seen significant growth and generated better underwriting results than the broader property and casualty industry. So next we'll go into Kinsale, and I'll make you presenter, John.
Okay. Okay. Let's see here. I'll change this to slideshow. I'm going to cover, real briefly, I'm going to cover 9 through 15. So I guess, 7 slides. So that's what I'm covering. This is just the, just loading, just the cover picture. So nothing there. I'm going to skip this first bullet. You can read it if you want to, but it's like, this is what Joanne was just talking about. And this is what this particular company, Kinsale, covers as the second bullet. This is their biggest businesses: small business, excess casualty, construction, commercial property, allied health. Now it seems diversified, and I guess by business line it's diversified, but it's all excess and surplus. So it's a pure play company actually for excess and surplus. I think the only one, I think I read that somewhere, that the only one for excess and surplus. So, and this is kind of a summary of what Joanne said as well. Newly established companies or industries, high risk operations, insurance on litigious venues, or companies with poor loss history. So it's kind of, as I'm going to say a couple of times, it's high risk, but it's high reward as well for various reasons. This is why Kinsale is this sub-bullet, this page here. They're really proud of their technology platform. They really think it's really awesome, and they're really proud of it and talk about it a lot. Their underwriters have extensive experience, and they focus in on various business types. So their underwriters are very specialized. And I kind of gathered, they didn't say this obviously, but I kind of gathered they've been poaching underwriters from the excess and surplus arms of various companies to, because they're a relatively new company. I think it's 2006, 2009 that they were founded. Can't remember which one, but pretty new, and they've been poaching underwriters that are experienced in these fields, excess and surplus. They focus on small to medium-sized accounts. They avoid the big businesses because they think they have less competition on the small, medium-sized accounts and can set better prices. They can make more money off these small, medium-sized accounts because they can get better margins, I guess, you know. So some of this I already covered. I covered, this is just an infographic, but I covered 1, 2, and 4. 3 is they maintain control over claims, and they contest claims that are not they feel are not justified, but they don't farm out the control of claims to someone else. I guess that's what other companies do, is what they were kind of indicating, and they don't do that. They have 1% market share in the market of excess and surplus, so they feel like they can grow really well. And you'll see on the SSG that they are a small company. We're always looking for small companies, so they are a small company by revenue. This is a little bit, I guess, interesting to read, but it's so combined expense and loss ratio. So expense ratio is like, the ratio is premium to this thing. So premium to expense, you know, or expense to premium, I guess. So what the expenses of basic business expenses compared to the premium for them is 23%. The loss ratio is like how many losses they had to pay out, what dollar amount of losses paid out compared to dollar amount of premiums brought in. And 59.8% looks like, and that's pretty good. It looks like the second best of all these companies overall. And I guess AMSF is the only one that's, these are probably competitors in the same, they actually have some excess and surplus lines, because I don't recognize any of the names as far as by the tickers at least. So they're probably competitors in that field as well. That's what they mean by competitor, or peer is what they say. But so this is strengths and opportunities. Some of this is repetitive, like I said earlier, it's repetitive stuff here, but they operate exclusively in excess and surplus. So they can just focus in on that. Underwriting team is highly experienced and focuses in on particular this risk only, excess and surplus, and their businesses that they have, they focus on for their you know, each underwriter focuses on a certain business only. They like their technology platform again. They go have an enduring competitive advantage from that. Now, there are more strengths and opportunities. They can function at a lower cost with their technology platform. And this is what I said earlier, they operate all claims in-house. They vigorously contest claims they believe are without merit. Their management team, the management teams, so like the executives have 25 years of experience, combined average of 25 years of experience, and they own some of the company. So that I think that Buffett would like that. Buffett and Munger would like that their interests are aligned with the stockholders because they own decent shares of the company, decent amount of the company. And this is what I alluded to earlier. 1.2% is what they have. They have 764.4 million. The total estimated market is 66.1 billion. So they're definitely have room to grow. You know, they don't have to worry about the guarding their market share. They got to go get it. So that's what they're going to try and do. And here's the weaknesses and challenges. This is all kind of common sense. I got this from the annual report. This is all kind of common sense. You know, insurance companies are exposed to the possibility of large losses, and excess and surplus is more exposed by its very nature because it contains more risk. Revenue growth has been strong in recent years, but it's going to slow down if the insurance market softens, and the whole economy could be softening pretty soon. So there is already. As it's a growth company, the shares of price of Kinsale has been volatile and could fall with bad news. So it's pretty common sense, all 4 of those. And I think that's all from that. So I'm going to exit out of that and go to the SSG. So this is the 10-year. It's very up, and it looks pretty straight, pretty parallel, relatively straight and parallel. There's nothing in for 12, but I'll go ahead and just in case. I'll let me go to the 5-year just to show you that. And as you can see, earnings per share and pre-tax profit has gone up recently. Historical sales has stayed steady. It's pretty much the same. So since it's a small company, you know, we can see that the 2021 revenue was 640, and that's obviously a small company. Yeah, less than 1 billion in sales. I picked 20% for forecast sales revenue growth for the next 5 years, could be a little bit high, but I figure they're so small. They've been 38.2, 37.3. That they're just trying to grow. They're a growth company. They're a high growth company for sure. That's what they're trying to do. I picked 20. That led to a preferred procedure of 15.4. I didn't see a reason to edit any of these. So 15.4, I just went with the preferred procedure, and that's where that came from. Now this is good. This is up and up, and they're both pretty healthy. This is up the debt, but it's very small. Obviously, 5.8% of debt to capital. So I'm not worried about that. As far as having reserves, however they calculate that for an insurance company, I'm not sure how they do it. I don't want to go into a rabbit hole here, but this is their balance sheet, and they have the reserves in this line right here, and reserves is a liability, but they also have these securities available for sale for a value. Is how they cover their investments. So I don't want to get into that rabbit hole just yet. So moving on to the next page of the SSG, I eliminated 65.3. Seemed like an outlier for high earnings per high price earnings ratio. Then it was above 30. Average and high P was above 30 according to the way I looked at it. So I picked 30 because I think that's generally how high we go. We don't go any higher than that because of rule of thumb. So I picked that. And then this is pretty much about 80% of current price when I did the study. It may go up a little bit or down a little bit. I'm not sure. I haven't updated it for the current price as of today, but pretty similar, I'm sure. And it could go lower, obviously, especially with the current macro conditions. But I thought that was reasonable. So 6.3 to 1. That's that. You also want to probably see this using forecast high P. The annual rate of return is 14.8, and average P is 12.0. And 6.3 upside downside. Now first cut. I don't have much here, honestly. It's a small company, so I didn't know how to do this, so I didn't do it. So maybe someone could help me with that later on. But company versus industry, obviously it's a lot higher. It's debt to capital is way lower, so it looks pretty good. Except for return on equity is pretty similar, but everything else is way higher. It's a growth company. That's already explained all this right here. I picked 20. So here's my rationale. Small company, I'll be going to industry. Just average, so there are very little inputs into the average. So the average is right here, but there's not much to go by because it's a small company. It's not being covered by these entities that I can find. So a small company operating in an underserved area of the insurance industry, that's for higher premiums. And yeah, they grow their business a lot more, and have less losses so far compared to traditional insurance, property casualty. So that's from the preferred procedure. It's preferred procedure number. Again, earnings forecasts not readily available. IP of 30, picture the price of this is 80% back when I did this, which is pretty similar. I said hold, and this is what it was before. I'm not sure why it jumped so much, honestly, but I had 4.3, and then it spiked a little bit. I'm not sure why, and that's went up obviously as well. But I said my recommendation is to watch, and I glossed over. I didn't actually cover it at all, but the reason is this is why we should buy it, right? This is a small company which we want, the projects to grow fast, which we want. Right now, the PE is above the average PE. And this is my prediction, many companies will fall in price as the Federal Reserve tries to curb inflation. I recommend watching this company and buying later when the PE, the price to earnings ratio, is inevitably lower. I believe it will fall, the price will fall, I think most prices are gonna fall. And so that's kind of how I saw it. So you can see right here, I refreshed the study before we started this call, and average per share earnings is 31.0, current 31.3. So it's not a bargain. And we also, there was another factor involved. We'll cover that during discussion of buying or selling stuff. But that's pretty much all I got. Any questions, or should we move on to the next one?
So their growth is based on number of clients?
Yeah, let me get up to the here. Yeah, number of clients. We're
And
trying to
how much
seek
they
out,
insure?
convert. Obviously, existing businesses need insurance, and here's their lines of business. I pulled the first like 5 from this list, and they're shorted by percentage of business. And so these are the types of businesses that insure.
Gross premium. Oh,
But
okay,
these
so
are
you based on the premium, based on how much you insured, not really number of clients. For example, I may only have 10
okay.
clients,
Yeah.
each of them like $100 million. You know what I mean? Like, or is households, they maybe premiums lower? Is that how they make money? They would rather.
Yeah, households definitely. Personal insurance you see is right here, and it's 3.5% of the whole portfolio.
So I know, I just want to make sure I understand. They are how they make money is based on the premium, the business, based
Yeah,
on
and
all these
how much losses
segments.
they have to pay out. Yeah, how much if someone has a loss, they have to pay it out. But most people don't have losses in any given year, and that's how insurance works. Really, is they take the premiums and put them in investments, safe investments usually. But they
So did they talk about how they grow?
well, they feel like they're like pretty much what I said. I mean, I don't have anything more to add, but what I would say to reiterate is that their technology platform is going to help them compete. They're pretty small right now. This is the main thing, I guess, to show that. This is what I would focus in on. Let's get my graphic here, and they're poaching underwriters is what I kind of picked up. They didn't say that because they're not going to say that, but they're picking up underwriters that they've known for years, that are experts in the fields, the businesses that they cover in excess and surplus, and they're giving them a lot of autonomy, but allowing them to focus in on the business and know what they're doing. And they contest claims if they're not good, and so this is the kind of stuff that they grow. And mainly, that they're pretty new and small. They have a lot of room to run. They're not that's the main thing, I guess.
Okay.
Okay, no other questions. I guess we'll move on, Joanne.
So I
Am I still
think
on the call?
Piero's next. Piero, I'm going to make you presenter. Piero, are you there? Did you step away? There he is.
He's muted.
Oh, you're self-muted, Piero. You have to unmute.
Okay.
Yeah.
You can hear me now.
Yes.
Okay, so I guess you're watching my screen?
Yes.
See my screen, okay. All right. Well, FAF is an insurer, just like John was talking about. These guys are, well, John is, Kinsale works in the specialty and the more risky end of the insurance business. FAF works in kind of the central part of it. It's less risky. They're a bigger company. It says, can see consistent revenue growth over the last several years of solid performance, higher number of closed orders coupled with increased average revenue. Activity pursues acquisitions to boost, expand its business. This is one of the activities that will increase its performance in the future. It's a serial acquirer. It keeps buying other companies, other insurance companies. Okay, the consensus estimate for Zacks, they keep on increasing it because they see the value in it. I think the stock has been punished, and its price has been punished unfairly. The stock price is down by about 9.6% as compared to 2.7% for the rest of the industry. Okay, that's it. This is the value line sheet for FAF. This is kind of a triple play that Ken Kavula usually talks about. this is the thing that you have to kind of look for when you're kind of investing. You want to see that, there's price expansion, room for price expansion. Right now, it's around about $55 rather than $59. They projected that the price in the future will be between, say, $100 and $140. So there will be price expansion there. There's suppressed PE. Right now, the PE is about 6.3, and the projected annual average PE will be around about 13, right there. So PE expansion. And then the third, last element of a triple play is margin expansion. I mean, usually the profit margin. But here they're saying that the premium margins right over here is going to go up to about 38%, whereas in previous years it was down to about 35. So when these three elements get together, their price it's going to go up. The price is going to go up. That's forced to go up. Okay. Let me see. Look at my notes. Anything else there? No. Okay. So go on to the next one. Now this is the again the value line sheet, and I thought it was the next. Oh, again, this is the bottom half of the value line sheet, and they have over the next 5 years, they think they will be growing. Their premium growth will be about 10%, and their earnings growth will be about 8%. So, which is usually found here on the left side here, about 10% their premium growth, and then earnings growth will be about 8%. So Value Line likes it. Let's see what else there is. Oh, I guess in here I can go to my first cut. Okay, and in first cut, I try to make it bigger if I can. 100%, 125. Okay. So at the time that I did this, it was selling at about $59. Right now, it's selling at about 55, maybe slightly less. Historically, sales have been about 9.6% growth rate, and the rest of the industry is about 0.6. Earnings per share about 26.7. So it does grow earnings quickly. The rest of the industry is about 4.8. Pre-tax profit is about 28%, which is pretty good. The rest of the industry is 5.1. Percent of pre-tax profit on sales is about 12.7, as compared to the rest of the industry is about 12.9. Similar. And return on equity is about 15%, 10% for the rest of the industry. Debt to capital 23%, 24%, kind of standard for the industry. Current PE is about 5.6, and the rest of the industry is about 4.75. So it is a suppressed industry, and I'll tell you why it's suppressed. Okay, it says sales growth, where will it go from the beginning? I want it to be more conservative than the analysts because we're moving into a recession. One really doesn't know how deep the recession will be, and I prefer to err on the side of caution. Not only are we heading into a recession, the company is coming off a couple of bad quarters. The reason why FAF looks bad is because in 2000 or before 2020, they wrote a bunch of property and casualty policies that turned out to be a mistake. Anyway, in 2020, or earlier part, they realized that it was a mistake, and they decided to sell that sector of the economy, that section of the business. And that was kind of the first kind of bad piece of bad news. But then when they looked at it, they realized that they're not going to sell that part of the business. They're just going to try to offload the bad policies that they wrote. So they got in touch with third-party insurers to pick up these bad policies, which they didn't say were bad. They just said, come and take a look at them, see which ones you want to take. So the third-party insurers took as many of these policies, bad policies, as they wanted, and FAF I said the remaining policies that were not taken were going to be honored, but they will not be renewed in the future. So they're going to cut their losses. Now, after 2020, they lost about $60 million because of these bad policies. So going forward, they're still going to lose money. Okay. So because of this, you know, many of the investors were looking at this and they say, oh my God, they're going to sell one of the bigger sections of the business, property and casualty. Of course, it's going to go down. It's going to be, you know, losing earnings per share, losing sales, losing everything. So price dropped. Okay. So that was one of the reasons why it had relatively bad current performance. Now, projected earnings per share, I said 5%, again, because I wanted to be more conservative than the analysts. Warnings Value Line says their earnings are going to grow at 8%. Well, I've made sales grow at 5%, whereas Value Line said it should have grown at 10%. So anyway, I think Value Line wrote their review just slightly before this inflation became a permanent fixture, because if you remember, inflation was initially pronounced as being transitory, right? And everything was going to go back to normal until they realized that it's not, and realized that inflation was going to stay here and it's going to be a global problem. So, you know, Value Line said 10% top line growth. I said 5. Value Line said 8% for earnings. I said 5. Okay, to be more conservative. Okay, so earnings growth. Yeah, 8% for 5 years. Morningstar, interestingly, they didn't make an estimate on earnings growth, but they said net income growth. Net income is just before it just becomes earnings per share. Divide the number of shares that you have, divide that into net income, and that gives you earnings per share. Well, if net income grows by 37%, earnings per share certainly will grow as well. So this is going to happen for 3 years. Yahoo Finance 12.5%, 5 years. NASDAQ 1 year. Other sources about 10% for 2 years. So anyway, 5%. Projected high PE about 10. Projected low price about 40. Okay, 40. I guess this will kind of lead the upside downside ratio 4.6 to 1. Compound rate of return about 17%. I say watch if we don't own it, but we do own it, so I'd say buy more. Explain your decision. FAF, currently FAF has a ratio, price to book ratio of about 1.4%, which means that we're paying about 70 cents for $1 worth of stuff, whereas the rest of the industry has a price to book ratio of about 1.3. So we're paying about 76 cents for $1 worth of stuff. Price to cash flow, about 5.09. That means you're paying about $5 for $1 cash flow. The rest of the industry, you're paying $6.65 for $1 cash flow. And I'm putting these out because, like I say, most analysts, Morningstar Value, think that this is currently undervalued and that it is down for unfair reasons. So it's become kind of a value stock. FAF, and price to sales at 0.74, which is, you know, we're paying 74 cents for $1 worth of sales, whereas the rest of the industry's price to sales is 1.5 at 0.05. So you're paying $1.05 for $1 worth of sales. So FAF has become a value stock. Currently has a dividend yield of about 3.4%. While you're waiting for the price to recover, you're picking up 3.4%, which is higher than this rate of CDs, right? Rate of CDs now are about like 1.5. So you're getting income that way. Yeah, so like I say, it's FAF is now a value stock, which is a good thing when you're heading into a recession. So FAF is buying back shares. That is increasing the dividend that it pays out to its shareholders. It is acquiring and making acquisitions in the insurance industry to bolster its position in the future, while keeping its eyes on the level of debt, which at this point is about 25% the capital. I can go to my.
I have a question before you switch, Piero.
Yeah, yeah.
was it price to book? It was
Price to book?
yeah, above this.
Yeah. Price to book is
How
about.
do you come up with this? It's 1.42. How do you come up that we're paying 70 cents for $1? It's worth it.
Okay. Yeah, this is a bit of a mathematical trial and error, right? So you take price to book. So you go for price. Well, the denominator and the division always revert to 1. Okay. So we priced, if the price was $10 and the book value was $10, it would be 1. Right? The result, 10 divided by 10 is 1. If the price was $10 and the book was $9, and then it would be 0.9. Right? So, but if the price was $1 and the book value was $11, then it would be the ratio would come down to no. Wait a second, I have to play with my calculator to get this here. Let me see. So, if the price is 10, the price is 10. Divide that by the book value of 9, and it would be 1.1. Okay, so price is 10. Divide that by 8, and that would be equal to 1.25. Okay, so the book value, we're paying about, oh, shucks.
Oh, I'm sorry. Pierre, don't worry about it. I'll research it on my own. I was just curious because I haven't ever worked with
Yeah.
everything else made sense to me, but the price to book, I couldn't figure it out. So I'll do some my own research.
Okay.
So I want to know is what does this ratio mean? Yes, we can do math. We can find, you know, price divided by book value. So what does that mean? Okay, see.
Okay, well, the book value that by definition means that if you sell a company, lock, stock, and barrel, everything in it, that's the book value.
If you dissolve the company, that is the book value. What is
That's
remaining
book
is book value.
Yeah, whatever
So-
whatever it's worth. And so the price compared to the book value, you're dividing the book value into the price, and you figure out how much you're paying for $1 of stuff.
If you have a lot of goodwill, price will be much higher than book value.
That's right. Okay, well, if you have a lot of goodwill, then it shows up, and you make sure that you don't buy it, because if goodwill keeps on increasing, then you don't buy it.
Mm-hmm.
All right. So, but that you can pick that up on Morningstar.
Pearl, it looks like you are paying $1.42 for $1 of stuff.
No.
Okay. I have one of my here. I think okay. This is my notes. Okay. I just had this here for to show that it's FAF is an acquirer. And so it's just picked up a Georgetown title. It's a big insurance company. I'll keep an eye on that. Okay, First American has increased impressive solvency level. Shucks.
Piero.
Yeah.
I think it's a very simple question. Most of the companies' actual price will be much higher than book value, right?
Yeah. Let me see it. First shares of American Corporation.
It will never.
Third quarter. Okay, provisions for insurance losses. Okay, that's I spoke about that. Or is it further down here? First American Financial Corporation, Georgetown. Insurance. Okay, I think this is it. Okay. The old company.
You can do a search, do the keyword or whatever you're looking for.
Okay. Control F.
Yeah.
Ratios. Okay. Okay, there it is. Ratio of FAF has a price to cash flow of 5.09. FAF has a price to sales and price to book. Where are you? Price to book. Okay, there it is. This company's current price to book looks solid when compared to its industry average price to book of 1.03. Okay, FAF has a price to book ratio of 1.22. Oh, I mistyped. Price to book ratio is pits a stock's market value against its book value, which is defined as total assets minus total liabilities. This company's current price to book looks solid when compared to its industry price to book of 1.3. So price to book for FAF is 1.22. I made a mistake on there. And the rest of the industry is 1.3. Within the past 52 weeks, FAF's price to book has been as high as 1.54 and as low as 1.18, which is a median with a median of about 1.42. Oh, okay, median. I put down the median value. Okay. Value investors also love price to sales ratio, which is calculated by simply dividing a stock's price with the company's sales. It's a preferred metric because revenue can't really be manipulated, as so sales are often a truer performance indicator. FAF has a price to sales ratio of 0.74. This compares its industry average price of price to sales of 1.05. So here we're paying 74 cents for $1 worth of sales. Here you're paying $1.05 for $1 worth of sales. Finally, investors will want to recognize that FAF has a price to cash flow ratio of 5.09. This figure highlights its company's operating cash flow and can be used to find firms that are undervalued when considering their impressive cash outlook. This company's current price to cash flow looks solid when compared to its industry average of price to cash flow of 6.65. Within the past 12 months, FAF's price to cash flow has been as high as 6.98 and as low as 4.91, with a median of 5.82. So they like it. These ratios say that, you know, it's a value stock. Okay, so I guess I'll go back to my the SSG. So in the SSG here, growth, historical sales growth of 6.6. So I said 5. The future historical earnings per share growth has been 18.8. So it does grow its earnings per share quickly. Again, the earnings per share I said 5. Here, pre-tax profit looks good.
I think you quickly that is 18.8 is the last 10 years, but if you look the last 5 years, it's about 5, 4, 6, 6. Oh, I'm sorry, 2011, something happened in 2021, it jumped, almost doubled.
Yeah.
Yeah.
Okay, so anyway, a return on equity is good. Debt is going up, you know, a little bit in the last year or so, but it's still below 30%. That BetterInvesting says. And then the other interesting thing about this is that analyst consensus estimate, nothing. Because they're
I don't think we ever look at those. I never look at the analyst consensus. I remember we discussed this before, even before Henny was on it. That was just one analyst is the consensus, right?
Yeah.
Because ourselves, we are analysts too, so we do based on our research.
Okay.
So for me, I am more interested to know why you chose these numbers, and I talk about before the meetings that like we can, like you said, we can put any numbers we want, but why we put those 2 numbers? What's the reason behind, right?
Okay. Yeah. Well, the
you
reason,
talk about how the earnings follows the sales.
Yeah.
But for me, also more interested to know you know, we talk about that. What drives their growth? Where is their growth come from?
Yeah.
Where does the growth come from?
Okay. All right. But you know, for the analysts are the professionals. The analysts, they get paid to be correct.
Because get paid. We don't know what yeah.
Yeah, they get paid to be correct, because if they're not correct, they don't get paid, right?
I'm not sure.
They're the professionals. They're the professionals. We're the amateurs, right? So we take into account their views. And what's it called? Here is with my projections of 5%, right? We know that going forward, sales are going to dip, but they're beginning to level out and they start turning up. Okay, so my 5% is not that outrageous. Then I'll go to another, let's see, valuation and return on the backside, right? High PE is, average high PE is 11.7, so I said 10.
Oh,
right?
your price is very old, June 10th.
Yeah,
Can you
yeah.
do a refresh data? Refresh just the price, go to data.
Data, okay.
And then refresh study data.
All right.
Just do the stock price over yeah. Assume they have enough. Yes, assume you have the latest quarter or whatever those data. Okay, 50.
Yeah. Okay, so there it is. 11
more.
Yeah, 11.7. I said 10. Right, and 12.67, $126. And then the low price, future low price, 64 bucks, is going to be higher than the current price, which didn't make sense, right? So I said $40, and I said $40, because $40 is what's it called? This is the last 5-year low price, $40. And this is a good choice when you have a cyclical stock, a stock that rises when the economy does well, then it falls when the economy does badly. This choice here, the recent the price that the dividend will support, that's for a dividend payer. Now, FAF is becoming a value stock, in other words, a dividend player. So $33, I thought it was a little too low. I said it's more kind of a $40 stock. $40 is about 20% below the current price, roundabout. And let me see, upside downside ratio is 7.6 to 1. It used to be a little bit lower.
Yeah.
Yeah, because of the price. And the overall earnings per share, high average PE, 23.20. So it's pretty good there. Everything looks okay. I wanted to show you another thing here. Well, here's the analysis. One of the things on the analysis tab for Yahoo is earnings per share trend. These are the analysts who follow the stock professionally, right? And they estimate their current earnings. They're earning this coming quarter, next quarter. So $1.87, they thought that 3 months ago. Now they brought it down to $1.80. Okay, so they revised it down. Here, this is for this is the current year estimates and the next year's estimates. Current year's was $6.80. They revised it down, $6.49. Next year, $7.27, and they revised it $6.97. So they're revising it down. So, but this is a short-term view. This is like for 1 year. You know, it's kind of an evolutionary process. It's, you know, it's down, but it's not radically down. If it was radically down, that would set off alarm bells. They still think that's going to be 12.47% for the next 5 years. 12.47% is good growth, but the next 4 years. And over here, they're revising their next year's returns down. So we know it's going to go down in the short term. In the long term, it's going to grow 12.47%. We know that. Okay. So FAF, and then I just wanted to show you the chart for FAF. Okay, this is, I'll show you something interesting here. This is the 1-year chart. I'll go for 5-year chart. Okay, 5-year chart. This is 2020 when they said that they were going to sell that section of the casualty and property and casualty section of the company. The price dropped because that's a major section of the company. Immediately dropped. Then it started coming back because after looking at it for about 7, 8, 9 months.
Why don't we go to the present, because we need to get to iRobot pretty quickly here. So.
Okay. Yeah. Okay. Go to the 1-year. Shucks. Okay. Yeah. So the 200-day moving average, the 50-day moving average crossed it on January, February, March the 25th. So it was going down. And the 20-day moving average has crossed the 50-day moving average on the downside just recently on the June the 6th. So it is going down. Okay. So what else is there to look at? When to sell checklist. I could show that. Right. So they say, yeah, we're having problems. The reason for the fall in fundamentals is that 2020 increasing inventory is not applicable. Decreasing negative cash flow, yes. So some of the indicators are telling me to sell or replace, sell or replace. Here, other indicators are telling me that, okay, relative value, no. Its relative value now is about 60% of what the historical value is, relative value. The downside ratio is lower than 1 to 1. No, it's not. It's about it's about 7 to 1 now. So some of these indicators are telling me no, they're telling me to hold. So it's a mixed bag. There's ones telling me to hold as well. So erratic sales, yeah. The PERT report tells you, yeah, we will have to do that. Projected total return, sales. I said so far losses are all on paper. I think the downturn for FAF is temporary, is most likely to turn around in not too distant future. Most analysts like the stock at these prices. You kept, okay. Yes, I would, okay, now that you've kept the stock, it's almost down as far as it can go, and it's got very much less to fall, and the upper potential is very much higher. So the price of FAF is unjustified. Yeah. Yes, company fundamentals and business outlook are deteriorating. Yes, but it's only for short term. Looking it over. Customer base is shrinking. Yes. Okay. When we look at PAF ourselves, the numbers are suggest there is happening. Is there anything fundamentally wrong with the company? No. Is there anything wrong with the industry sector? No. There is something wrong with the economy, right? And the economy is going to go into recession. So that's part of the downturn for FAF. FAF was founded in the 1890s, right? They've been through the Great Depression. They've been through the Great Recession. They've been through a number of recessions. They're still around. They know what they're doing. I would argue that FAF is down for unfair reasons, credit losses, FAF is buying back shares. It's increased its dividend. And at the same time, it's making strategic acquisitions in the insurance industry to bolster its position in the future. All this while keeping a close eye on its debt, the capital ratio, 25%. So I would say that for FAF, we should buy more. At the very least, we should hold. Any questions?
I remember Bernard loves this company.
Yeah.
But I don't know the reason why.
Okay. See, the other thing about its growing, what's going to drivers in the.
Can we quickly go on to iRobot, because we're kind of running out of time.
Yeah. So.
Yes.
Okay.
All right, we missed the annual report on iRobot.
So
no.
I'm going to give Oh, Mina, you can't show your, do you want me to do the?
Oh, unfortunately, yeah, I can't, I don't have the permissions on this
Okay.
laptop to get going.
Okay.
If you could pull up, yeah, the slides, that would be great. I'd appreciate it. Yeah, thank you, Piero. That was a really detailed, insightful review there. I think, yeah, some things more to think about FF. But yeah, so in terms of iRobot, the reason for inclusion of iRobot is, well, for two main fundamental reasons why we're taking a look at it in this model. It doesn't fit, and I appreciate it doesn't fit the financial portfolio review portion, given that this is of a consumer retail sector. iRobot, for background's sake, produces computerized vacuums and home appliances. So mostly Roomba is its most popular brand, or its brand name at this moment. They are an industry leader that claims a technological advancement over its competitors. However, that is starting to split. But anyways, that's for background. So the reason why we are looking at iRobot is its recent performance in the market, as well as its kind of relatively alarming earnings reports for the last few quarters, coupled with its very small position in our portfolio. As we know, the Better Investing guidelines and principles suggest that we shouldn't have any holding that constitutes less than 5% of our portfolio. And the reason for that being is that if we are going to devote the time and attention that's necessary to follow a company properly and to do the research, you know, that John and Piero have showed this evening, we need to, you know, be getting value for that time and for that effort. And at less than 5% of our portfolio, you know, in dollars and cents, if these were real dollars, we wouldn't be getting that value. The other reason is also with Mahesh's resignation from the club, we are, you know, we have fewer members. We want to make sure that we have the right number of companies in our portfolio to ensure that they're all getting the right attention. And so iRobot comes up as a prime candidate. So this presentation is going to be mostly about its performance because, as we'll get to with the SSG, they have a negative earnings per share for the last 2 quarters, and that makes it very difficult to properly complete the SSG. But in any events, currently iRobot is trading for, I believe it was 43 today. It did have it had a little bump, I think 3%, but so it's at $43 it's trading, which is below its 42-week low for the previous period. And so that itself may present a buying opportunity because the fundamentals of the company don't seem to have shifted fundamentally. It seems to be a huge drop-off in sales.
Do you know why the sales got? Oh, okay, you just go ahead. I'm so sorry. I cut you. Yeah.
No, absolutely. And the reason
you were just going to talk about it.
Yeah, it's multifaceted. So with many companies and suppliers, they blame supply chain issues in 2021 due to COVID shortages, especially for their semiconductors. And so in Q4 of 2021, they reported, I believe it was $135 million in unfulfilled orders that were just backlogged due to shortage of parts. So that contributed a significant part. There is also issues that they had with with shipment. And then also there is a significant growth in competitors, especially overseas. So they've noticed a significant decline in their international sales. Now, the company does, you know, there are other issues that seem to be trending in the wrong direction. For example, the debt to capital ratio has been increasing since 2020. The return on equity has been decreasing for that same period of time. Now, most analysts suggest that this company is going to bounce back because the fundamentals still continue to be good. They still continue to have significant amounts of cash. They continue to have the same leadership and management that's guided them through the good times. And now, so there should be no change in there. So iRobot also has released recently a new platform, a new operating system, iRobot OS, which iRobot is very optimistic about and expects to be part of their big strategy. It's a software that allows for more integration and for the robots to do better mapping and to do better work in the homes. So that does, it does contribute to increased R&D spending and marketing spending. So those as a portion of revenue have increased, and the company's gross margins have, for profits, have of course decreased as well. Now, in terms of company guidance for the next quarter, revenue between 1.6 and 1.7 billion, which would have year-over-year growth between 4.5 to 10%, or almost 11%, which seems fine, though this is a relatively small company. I believe it's a medium-sized company we have for them. And so those growth projections are below the 15% that we would look for ideally as part of the better investing principles. Joan, if you don't mind going to the next slide, please. So iRobot shares are down 33% over the last 6 months. So in some, given that we do have long-term projection for growth in terms of sales and back to earnings, it does present a buying opportunity from that But it is from that perspective. But it is alarming that their competitors have reported in that same period an average growth rate of 1.6%. So, a 34-35% swing is alarming. Given that the competitors are small and growing, I think would contribute to a lot of that. But that's that does pose a long-term problem. So, and this is the other portion that makes an SSG difficult and maybe makes this a difficult company to follow for the next while, is that revenues are forecast to shrink by almost 700% for the next quarter that's going to be announced in July, before jumping to 21% the next quarter. So really erratic numbers. The reason that, I'm reading management guidelines, or management guidance and their reports the last quarter, they don't really seem to explain why there's this massive dip, other than just kind of general supply chain shortage issues, but it doesn't seem to be hitting their competitors as much as it is them. And so that did strike me as kind of concerning, was the absence of real significant tangible reasons for the shortage. And then now with the softening economy that we're seeing, with the potential for recession, these kind of retail purchases are going to be some of the things that are first cut from consumers' budgets. So growth rates in the next 5 years are projected to be 34% by estimates from analysts and from management combined with their guidance, but that does seem a little optimistic in the current climate. And so I do have some concerns about that. But it is almost unanimous. Well, actually, it does seem to be unanimous across research that I could find that 2022 will be a bad year for iRobot and for the performance of the stock. So though we've already experienced I believe Reddy mentioned a 53% loss on our investment, on our initial investment, we haven't seen the bottom. It appears that we haven't seen the bottom of that yet. And so though, until we sell, we haven't realized that loss, it seems that we might be preventing, further loss and better investing the money rather than engaging in that sunk cost fallacy of continuing to chase our initial investment. Joanne, if you mind going to the next slide, I think there might be one more. Or is that about it? Because if not, then we'll go to the sell checklist. Yes, there is one. So, right, so here are some of the reasons that I noted that were in favor of sell rather than to hold, or to, well, again, hold was not really an option for us in this situation, given that it was only 2% of our portfolio. The options in the case of iRobot are either to buy more or to sell. And so the factors that really pointed to a sell were increasing competition and a noted decrease in the market share that iRobot holds in this sphere. And that is a problem I think that will continue to grow. This is the first in name or in industry, and this is the first brand that really made it big. It's it's difficult to maintain that position or that perch. iRobot continues to project supply chain interruptions, which would impact their inventory. And notably, they don't seem to release any numbers on their inventory for the past 3 or 4 years. They did in 2016 to about 2018 that I could find, but nothing since then. And it's going to increase the backlog of back orders. And then I think that's also a bit of a vicious cycle. When we have back orders, we have an increasing number of competitors that have technology that's competitive to have a similar product. Back orders are going to turn into lost customers. And so I think it's going to turn to a bit of a vicious cycle. IRBT has been downgraded by JP Morgan to an underweight company. It was previously rated as neutral. Now, analyst reviews are mixed on this front. There are some that have, well, a significant chunk have maintained IRBT as a hold company, while a number have shifted and downgraded it to a sell. And then just as a final point, the revenues are down 3.7% compared to the same quarter last year. That takes into account a good first and second quarter in 2021. So it seems to be a larger trend than just the last half of 2021 and the initial half of 2022. So these are all factors to me that pointed to a sell. And then when we completed the checklist, Joanne, if you don't mind pulling that up. The checklist also just the factors that did apply to it pointed to a sell, and so and to thank you again, Joanne, for doing all of this for me. Just don't seem to have the ability. I can't give it the authorization to share screen, but anyways, back to the sell checklist. The company's fundamentals. This was the main factor that pointed to the sell. It seems to be a deterioration, significant decline in the EPS in the trailing 12 months, decreased pre-tax profits, decreased return on equity. There's no specific information on inventory, but we have significant backlog of orders, meaning inventory is low or non-existent. And between inflation, fuel prices, continued supply chain issues, I think that's going to be a really significant problem. So that checkpoint issue was really the main sell. And then, as I mentioned, the decrease in market share was from 64 to 46%, which is a significant drop since 2016. And the international market, I mean, Roborock especially, seems to be gaining a lot of headwind because they're making a lot of promises. So we'll see if they can fill them. And finally, number 5 was also really 5 and 6 were also the big factors that led to a point that are independent necessarily of the long-term projections for IRBT. Again, this is 1.9% of our portfolio. We need to bring that up either to 5%, which would mean a further significant investment, or we need to sell. If it's not, and especially that this company is not performing super well at the moment, that there's no really motivation or incentive to make an exception to the rule. So if we are trying to, abide by better investing principles and to make our decisions in a principled manner as well as based on the technical analysis, then that would be a significant factor in favor of sale. And to improve portfolio quality, we've seen 2 presentations today by John and Piero that point to companies that seem to have much better immediate outlooks and healthy long-term outlooks. So those are examples amongst others in our portfolio, no doubt, which may present a better opportunity at the moment than IRBT. Now, the recommendation is sell, but the recommendation is sell and immediately put back on the watch list. Given it's such a low price, the long-term outcome does seem favorable if they're able to navigate the upcoming difficult year. So it would be a sell recommendation with a strong preference to buy it at a later point. But we can look at so I wasn't able to prepare an SSG because I spoke to Joanne and Piero and John about this, but when I put in the numbers, the sales projections and the EPS based on kind of the long-term projections and analyst guidance, it returns a buy at like a 9-to-1 upside down ratio. And BetterInvesting has a big banner kind of as soon as you go into the SSG for IRBT that it's difficult to predict, and the models are going to be a little bit wonky because it has a negative EPS this quarter and the last quarter as well. So it makes it really difficult to use the SSG effectively now. I'm not sure if anybody wants to kind of go through a discussion or try and see the SSG, but I'm open to that. But I didn't think it was. I didn't think it was helpful.
At a time.
Yeah. Okay.
So I think you've given a strong recommendation to sell this stock, given that we need to sell at least one stock. So because we're over, since Mahesh has no longer part of the club, we need to balance our portfolio by selling a stock. So yeah, go ahead.
Yeah, no, I think you're exactly right. And as much as we hate taking an unrealized loss and making it a real one, you know, we haven't seen the bottom, and there are better investment opportunities. So, like you said, we have to rebalance anyways. This is a good candidate. So, unless there are any questions, that's all for me.
Okay, thanks, Mina. I
Thanks.
think that we should do is we should. Are there any motions to buy or sell? Last month we had motions to buy $1,000 of Google and $1,000 of FAF, which didn't pass because not enough people voted. So if you want to.
So we just presented the FAF again tonight. Is it also a buy, right? But why do you guys want to challenge? You want to challenge the FAF because you want to sell it, right?
Well, because we've found a stock, Kinsale, that we thought was a good small, because we're looking at balancing the portfolio, and it's a small, fast-growing company, and FA, and it was a financial company. So we don't want to add to the finance industry, our sector, because we don't have enough people to follow stocks. So it was put up as a challenge. So I'm ready.
I thought the goal for you to put up a challenge, I thought you replaced that, you know, you're presenting or you propose to replace FAF.
I think initially, once the idea was that hopefully maybe it would have been, but I think when Piero started doing kind of more in-depth research and his presentation showed, I think the evidence pointed towards a buy once the
because we initially felt that FAF was too slow growing.
Right. But further digging, and you know, there's a different recommendation today, but
right. Yeah. My recommendation is to sell one stock so that at least each of us just to follow one company.
Okay.
To minimize our load. But however, I'm trying to understand FAF, iRobot, not this new company. I'm just a bit confused. Which one is the best? Or even though, yes, iRobot is declining, and I'm just looking at, actually, their manufacturing now moved to Singapore. So, Mina, I just want to understand. They are saying that it's just supply chain caused all these significant loss in 2021.
Right. Like
Did
a lot
they talk about anything about what will drive in 2022? What's there?
So they believe
anything.
Shortage for so they're hoping that they've experienced a major shortage of semiconductors, a component.
Oh, okay.
Just like a lot of other technology and kind of electronics companies, they were facing that shortage. So they're hoping this year that issue is going to resolve with, I think some plants are becoming operational. So I think, but that's also the reason why they're going to face some headwinds for the next 6 months or so, is because it's going to take time for that problem to fully resolve.
Hi, this is Isla. I just want to add something about iRobot. Not only do they have the problem of trying to move their manufacturing facilities out of China and into other Southeast Asian countries, so they're spending money in that way, but they also are subject to tariffs for bringing their products into the US. Now, the tariffs have been suspended for this year. And with the outlook for this year and the tariffs are suspended, what happens if the tariffs are not suspended next year when they're expected to do better?
Right. Very good point.
Yeah, so that's a problem. And they're pretty much
Yeah.
always going to have that problem because they're not going to move their manufacturing here. It's always going to be there, and there's always going to be that shipping thing and that delayed shipping thing in the ports and all
Right.
that mess that goes on, and the extra money that you have to pay to get your stuff moved once it gets to the port. So they have a lot of challenges in terms of how they have to spend money. It's still trying to get those manufacturing facilities up to snuff and up to code.
I agree. Yeah, about the supply chain, I'm just
So,
looking at our portfolio. I want to see
yeah.
anything else. I guess we already sold the other companies that was the chip makers we used to have.
Yeah.
So in our portfolio, there's no chip maker. Yeah. Yeah.
I mean, it's a good problem to have. It means our portfolio is quite lean as it is. You know,
Mhm.
all
Yeah.
our companies are pretty well performing. So if
Right.
we're looking at iRobot, it's
Right.
because it's the bunch essentially, not because it's a bad. I don't
Yeah.
think it's necessarily a bad long-term investment
Yeah.
of what we have.
Yeah. Well, I would say just get rid of the iRobot then.
Yeah, I
Yeah.
think that's a good idea. Yeah.
Mhm.
Motion of sell iRobot, all our holdings. Does anybody want to second me?
Oh yeah, I second. This is John.
Thank you, sir.
Oh, this is cool. Could you close voting sooner if majority is reached? Do you
Yeah.
usually click that, Giant? Or
What happened?
you do click that? Okay, that's what you do usually click. Okay, got it.
Oh.
All right, got it.
Yeah,
I
remember-
don't see the screen, so yeah.
No, sometimes we used to do it by time, but then
Why? Okay, that's the problem. Oh, July 22nd, next month. Define voting end date.
unless all members have
Did somebody second?
What's the next? Oh, I don't know how does that work now.
Did
I thought
somebody,
it was
did somebody second?
John
John.
did.
John did.
And does this look right? 7/22, that's,
Is that right? That's next month meeting.
So
Oh,
I think
hi, okay, thank you.
Uh-huh.
yeah, should we not have it closed sooner if the majority is reached, or do we want to have if all members have voted?
This one. If majority is reached, close vote.
Oh, maybe that was why. They changed the default.
Close
We
vote,
want to close when the majority reached.
okay.
Yeah.
Okay. All right.
Oops. I forgot.
What?
I clicked on it twice. Okay, all
Oh, okay.
right. So is there any more motions? Is there anything for FAF? Do we want to buy more FAF? I think Piero's recommendation was buy or hold.
Well, I'm not 100% sold between those two companies. How much do we have already in
I think FAF is the one thing I shared in the group when we were in the group is that it has a price to earnings ratio of 5, and other price ratios that are really low as well. I mean, on the one hand, that's like attractive. You're like, wow, it's so cheap. But then on the other hand, you can't be the only one to like your company that you're investing in. Other people are going to like it too, or else it's never going to go up. That's just practically speaking. So
Is there
a
any chance of any
low price
PE
earnings ratio is kind of a warning signal to me. It's kind of like a
Is there
red
any
flag.
chance of any PE expansion at all
Yeah,
with that company?
yeah. You see the current PE is about, on the value line that I presented, I think the current PE was about, was it 6.7, something like that. And the future average PE in the future will be about 13.
Okay.
Okay, the triple play, price expansion, PE expansion, margin expansion.
Has the PE ever been 13?
No. Well, and in the past, they sure, I think it was, yeah.
Was it like a one-off thing, or was it something that was fairly steady and just got screwed up when price fell?
No, I think it was a fairly quick growing company. I think the PE would have been much higher, right? I can go to, I guess, Value Line, Yahoo, and look up their history on it. Let me see.
FAF is 8.08% of our portfolio right now. I feel like that's pretty good if we want 12 companies. It's right on line. Vertex is big.
Vertex big is because growing, right? Because it's because the return, not because.
That's what I thought, but then we looked it up during the group. Didn't we remember that? Anyone that was in the group remember that it was like we bought a lot of it too.
Oh, did we?
I saw.
Okay.
Familiar.
Oh, I see. Oh yeah, you're right. Probably bought a couple of times.
We bought a couple of times, yeah.
Yeah.
Do we want to do anything with FAF?
FAF will have 8%. I don't know. Up to you.
That was kind of a hard one to know because it's not a fast grower. I don't really know that PE is going to expand that much or that it's going to grow that much. Well, it's not in an industry that's growing that much, and it itself is not that much of a grower. So I don't know that it's going to live up to the, better investing standard.
Right.
Yeah. I think we should keep.
Oh, sorry.
It's okay, Mina.
Okay. Jane,
what are you saying, Jane?
Jane, you go. And
I think we should keep cash because next month we are going to have a new study, right?
Okay.
So we should keep cash.
Right. Another reason we should keep cash is because the market is dropping. We may want to, buy something else because we got the money.
Well,
exactly.
Funny, actually, I was going to almost suggest the opposite in the sense that we have, 8% of our portfolio is now cash. If we sell IRBT, that's an extra 1,000. With inflation, it is. Are we not locking in, 8 to 9% loss by keeping that much cash? Like, should we try to invest some of it now that the market's down? We have cash on hand. This is the reason why, right? We can average down our costs. We can make some purchases. I think,
we can make some purchases, but not
possibly not FAF. I have no
Well,
problem to purchase. I don't know what to purchase. I'm just not convinced.
Won't we have a significant number of companies that will be more in the buy zone as a result of price drops recently?
Yeah.
Sure.
So when we look at the stuff next month or the next month and 2 months actually, there might be companies that we have more faith in whose price is now lower and we can spend that money at that time.
Like the 5G companies we looked at.
I was just going to say, looking at where the 5G, we did not buy 5G. They were on the watch list.
Yeah, because they were overvalued when we.
Oh.
It might not be now.
Okay.
It might not be now.
Yeah. I want to present another company. Jean and I know you guys are working on it, but not the industry. Intuitive Surgical, that company price got dropped. They had a split, but they also had it was in a good price. Did you have an Intuitive Surgical?
Okay.
I used to look at it.
Okay, we're way past time. So do we want to go through the guests' comments and excuse them and then go to club business?
Sure.
Right.
Yes.
Sure.
Yes.
Okay.
Okay, so I guess looking at the list here, I see Evelyn. Hi, Evelyn. You're muted.
Self-muted.
Self-muted. Hi, Evelyn. Okay, well, thank you for joining. I see that you've unmuted yourself, but I don't think I can hear you. If not, well, welcome. If we hear from you, we'll hear from you. If not, thank you for joining us. Next, Jessica, are you with us still?
She's also self-muted. Oh yeah, she's unmuted.
Hold on.
Yeah.
Hi.
Hi.
Go ahead.
Do you have
I
any?
don't have any questions.
Oh, you don't? Okay.
Well,
I'm
thanks,
very new to this.
thanks
I'm
for joining our
just
meeting.
trying to learn. Oh, thank you.
Well, welcome. You're welcome anytime. Appreciate you joining us. So, Joel, I'm not sure. I think that's the. I don't know what that. Oh,
Hello.
hi,
Hi.
Joel.
Hi. No real comments. I was just intrigued with the interaction between the members. I enjoyed the pushback, the questions that were asked. I think those are important, and the various forms that are used. The first cut and all the challenges. What is it? First cut and then the sell checklist. I wasn't familiar with those two. So it's interesting, the interaction. I enjoyed the meeting today and learned a few things. Yeah, so those are all my comments.
Well, thank you so much, Joel. We really appreciate it. And yeah, we find, more heads the better, right? We go finally learn some things.
Yeah.
You're always welcome to join back. Thank you.
Thank you.
Hi, Kirsty. Kirsty, are you still with us?
Christy is.
Yeah,
yeah.
Well, thanks for
Okay.
joining in. We appreciate it. Hi, Mel. Are you still on with us?
Yeah, I'm here.
Hi, Mel. Well, thanks for joining. We wondered, do you have any thoughts on any opinions?
Just some questions. So your portfolio is fictional, correct?
Yes.
Yeah. So the treasury report, that would be fictional money,
Well,
correct?
yeah. Well, so we have regular deposits of fixed amounts based on the number of members.
Per member. Okay.
Those
So
regular deposits, and we track purchases based on the purchase date price of the companies. We'll purchase a fixed amount usually. So we didn't make a motion to buy today, but you'll find we'll make a purchase for $1,000, let's say, or two, whatever it may be, and
correct.
that will track the portfolio. So yes, but otherwise all fictional.
Do you track dividends?
You know what? That's
Yes,
a
yes, we
good
do.
question. Yes, I'm not good with numbers, so
I think
terrible,
we do.
Okay.
of course.
We
So
do.
you do track quarterly dividends or?
Mm-hmm.
Yeah, we know,
Okay.
and we do track which companies do provide. It's part of the analysis for the buy and sell. Yes.
Yeah. Okay. Okay. How much work do you guys do on average on all of this
A lot.
between meetings?
Well, so it varies because we ask that members each present at least once a year, present a stock study. So those months will obviously have a little bit more work than others. And then once you're a member, you'll also be in charge of watching a stock. So that'll involve giving quarterly reports when they become available, and an annual report. And those months, maybe a little bit more work than that. Otherwise, most of the work as a member will involve, reviewing the reports that other members are generating before the meetings, just so that you're familiar with the stuff, doing your own research so that you can engage in discussions. But so that'll vary between individuals, but that's really the kind of the commitment. And unfortunately, you didn't have a chance to see a quarterly report. They're usually a little bit more succinct, like probably about a 15-minute, 20-minute presentation about the company, its performance, and then a quick updated SSG. So yeah, I mean, I don't know if that helps answer the question at all.
No, that's fine. Thank you. No, nothing further for me. Thank you.
Mel, sounds like you belong to a club. How are we doing?
No,
you
I'm
don't?
I'm a do-it-yourself investor.
Oh.
So I used to be a member of the Canadian Shareholder Association for quite a while, a long time ago.
Mm.
They're no longer around. So I joined BetterInvesting, I guess it's now 4 years, because I was using an investment advisor, and cost benefit, it wasn't worth it. So I took over the investing.
I see.
Say that. I had to convince the wife, but she trusts me. So
Yeah,
But
we do
I,
have a,
but
we do have
I've
a,
been using this methodology for quite a while.
mm,
Every
yes,
stock pick I've ever done in my life has been based on this method, except
yes.
one stock.
Mm-hmm.
Yeah.
Yeah, we know it's working.
No,
Yeah, we love it too.
it works.
Yes.
So I guess I don't go quite as in depth as you guys do. I'll usually make my mind up in 10, 15 minutes, whether it's
Mm-hmm.
worth something to pursue. So
Mm-hmm.
I've used Value Line, but that was before the computer age.
Mm-hmm.
It was the only, but I don't use it now. Mornings, I don't usually use that at all when I invest. So I quickly look at the financials, and then I'll look at the revenue growth.
Mm-hmm.
That's how I do it. But same method you're using. Just try to make a reasonable assumption.
Right.
Yeah.
Yeah.
No, it was good. Good. I thought
That's good.
FAF was reasonable.
Yeah. Visit us anytime, or if you're interested
Yeah.
in joining us. Yeah.
Okay. Well, thank you. I might join next meeting.
Okay.
Yeah, we have
Sounds good.
We're interested. Yeah.
so definitely feel free to join us again. And if you have any questions, shoot us an email.
Yeah,
Yeah.
Mina's also in Canada, from Canada. We have a
Well,
couple.
she's Canadian too. Okay. Yeah.
And Piero,
So are you investing mostly USD stocks?
So in this, yeah. So this organization, it started off as it's all U.S. companies, U.S. trading. Yeah.
Okay. Yeah. I would also say take a look at Algonquin Power.
Yep. So that is
Yep, we
purple.
have that.
It's gotten quite cheap lately. So
Yeah, we
Yeah,
have that in our
I own it.
portfolio.
Yeah,
Yeah.
no, we do as well, and no, definitely, and that's one of the benefits of part of this club and being part of this club. You have that in depth of things that you might already own or things that you might get ideas for your own personal portfolio. And that's really what we hope to get with the club. So, yeah,
Okay, good. Thank you. Appreciate it.
Joel has his hand raised.
Oh, hi, Joel.
We gotta unmute.
Oh, yeah, we mute. Okay. Oh, whoops, somebody.
I did that. You want to unmute him?
Okay. All right, Joel.
Just a couple of questions. Does the club invest on ETFs or index fund?
No.
We don't. We have education topic. We talk about it. Educated us. How does that work? But as a club, we handpick individual stocks.
Yeah, but as far as ETFs, yeah, there's no purchases on either one, ETFs or index funds.
Correct.
Just individual stocks.
No,
Yes.
we don't follow each. The reason why we do the individual stocks is it gives every member an opportunity to actually follow a company, make sure they understand how to assess, do an analysis.
Yes.
Your investment.
I was thinking that might be, I mean, in other words, if you're interested in balancing a portfolio that says, these are small companies or medium, or maybe it's in an industry, that might be a good way to fulfill that requirement. But okay. The other question is how to join, or what's the process for joining?
If you look in your on the right sidebar, there's a handout. Or actually, no, it's in the in the
handout section. You're right.
Is it in the questions? Where is that?
Chat. Handouts. Handouts.
It's called guest FAQs.
Oh, and look under chat because it says member, how to become a member. So do you see?
I see two handouts. You're saying this one of the handouts?
Yes, the FAQ.
There's an
FAQ.
But then there's also under chat, there's a how to become a member.
Oh, great.
The FAQ is kind of a history, or
okay, I'll take a look at that.
Oh yeah.
Thank you.
Both.
The how to become a member is a little bit more detailed.
Yes.
Okay.
It could scare you.
All right, sounds good.
But you know what,
Okay.
Joel? We offer a lot of support.
Definitely.
We're together learn. We're in this journey together. It's a lifelong journey.
Yes,
Member-
I've been a member for a club. I'm no longer a member of that club, so I am interested in the educational presentations that you've given. I like that, and certainly better than the club I was in. So yeah, I'm interested.
Where do you live?
Good.
What state?
I live in Oregon.
Oh, perfect. Okay,
Oh,
West Coast. Okay.
West Coast.
You
Yeah.
don't have to stay up late like our East Coast friends.
Yeah, we're in some of us in California, some of us East Coast, a couple of them in Canada.
Muted.
Yes, I'll review the prospective member requirements and follow it there. Thank you.
Sounds good. Thank you.
You. Now, sorry, just go back to the list here. Hi, Philip. Are you still with us?
It is muted. And then
Okay.
Ron.
Hi, Ron. Ron, are you with us?
Yeah, I'm still with you guys. I think that Jane Chen, is that her name?
Yes, that's
I
me,
think
Ron.
she did an outstanding job on the presentation on Berkshire. So I'm gonna tell G Eagles and that never
Unmuted.
you as a club member.
Oh, yeah, that's not me. That sorry, I thought Jake, yeah, because my middle name also changed. I thought Ron, if you talk about me, yes, she did a fantastic job.
Yeah.
Yeah.
So the part I like about when I think it was Isla Barnes that said, how come
Yes.
Warren Buffett likes Tim Cook? Well, when you invest, what is it, $31 billion in Apple, and then when you look at your result and you have 161 billion, what is there not to like, right? I myself, I don't own Apple, and the reason being is because Apple's PE ratio is 20. Is their PE ratio, and if I buy Berkshire Hathaway, their PE ratio is 6.5, and I get $80 billion worth of Apple to go with it, besides the 85 different companies, besides a chairman that doesn't get paid $20 million a year, because Warren Buffett only makes $100,000 a year.
Yes.
And I get $100,000 or $100 billion of cash to go with it. So to me, Berkshire is a better deal than Apple. Personally, as an individual stock, I buy Berkshire over Apple.
Yes.
But I also think that Isla Barnes, I think is her name.
Yes.
I think she's pretty savvy, because she says at the end, let's keep the cash. And part of it is because, next month they're gonna raise the interest rates again. The Feds are. So the stock market's gonna take another hit. And so right now, all the stocks are actually for sale. But you want to pick companies that are great companies at a fair price, right? And so by the demeanor of Isla, just waiting and being patient, to me, that's a very good trait of an intelligent investor. I mean, you have good people there in your club. Okay, and they seem to know what they're doing real well. I just got through of my own investment club, and I gave a whole presentation on Google, and we bought a whole bunch of Google. But I'll send G my paperwork, because I send G every month my presentations. I don't know if she shares it or likes it. I don't know. I just send it to her. She can delete it if she doesn't like it.
I did not delete. I'm just not catching up. Ron, I share with my club members.
Yeah, one thing that I did, and I'll send it to you, about Amazon. Everybody, the sentiment of Amazon is so high, but Amazon only makes 4.5 pennies on every dollar in profit. And so Amazon is $137 billion in debt. And normally what you want to do is you want to take a company that has free cash flow, whatever the free cash flow is, and you multiply it times 5. And then you want to make sure that the debt doesn't go over that 5-time multiple, which means that out of the free cash flow, they can pay off their debt within 5 years. But anyway, I'll send that out to you.
Okay,
Jean,
thank
so
you,
you
Ron.
can look at it.
Okay,
Okay?
thank you.
Anyway, that's all I want to say. So it was great presentation tonight by you guys.
Thank you.
Thank you.
Thank you. Thank you, Ron.
I'm
You're
going
welcome.
to excuse the guests, and you can go on and do the club business, Mina.
Perfect. Thank you.
Do you see my screens up, the agenda?
No, but I have it up online anyway, so perfect. So we have the one vote. So club business, the first thing we had to deal with was we have to sell the stock due to Mahesh's departure. We have the motion out currently for IRBT outstanding, so we'll see how that returns. Hopefully that will be due with it. I think the more important matter, Jay raised this, and I think she proposed a really good solution, but I'll pass it to Jay about how to deal with club dues and making sure everyone can get the remittances in.
Okay. So as right now, we know we get we need to pay BI $52 club dues, and we divide it by number of members. This year we pay $4 each person, pay $4. But I forgot to present that another portion of it for BI. BI have 3 components in membership. Club membership, $45 for the club membership, like you are the BI membership, and the $75 SSG. Being an individual BI members, you pay $120 each year, except the lifetime, Jean and Bernard. So we pay $120 each year. So it's so hard for me. I forgot to collect the $45 from some of you. Reason why I said some of you, because Isla, Reddy, Piero, you guys are still as an individual member, or you belong to another club. I don't need to collect that $45 from you. I call the BI, it's complicated. I have to call when you call BI and separate you. What I'm thinking is this: why do we, all of us, just pay individual to BI? All we do is just pay that 52 divided by number of the members. Does that make sense to you? That actually was our initial goal, but somehow when BI sent out the roster, I end up there was dividing. I remember it was so very complicated. Henny have to send emails explain that how BI divided the membership in 3 components. So
what you're proposing is that we pay them for the membership of the club, and then for our money for the stock tools we pay ourselves?
Yes.
Which I think most of us already do. So are you? So it's so the only additional component would be that joint club due, that $52 that is divided by that $4 or whatever.
Exactly. Right.
And so I think that makes total sense.
Sounds reasonable. Yeah.
Yeah.
Sounds very reasonable. Yeah.
Right. So this year, John, Joanne, and Megumi, they paid me the 45. So I paid. We do need to still need to have this roster, and I'm going to keep these 4 of us as just local, so easy for me to get the money. The worst case, maybe just me and Joanne. I don't know how many people has to be on the roster. I don't know. So for this year, all I did was just keep 4 of us, and the rest of you will be all just as individual BI member, but we just paid the additional.
And so, divided by. You know if that will just be added at the annual renewal, or is that going to separate fee?
Be the next.
You can't have people's addresses up and phone numbers up because recording. I'm gonna have to.
Oh wait. Oh yeah. Oh sorry.
That's okay. I did that mistake.
What we could do is just delete maybe that portion.
I gray it out.
Okay.
I'll gray it out. Okay. Sounds good.
Can I ask one more question?
Yes.
How do we pay for Zoom?
We don't pay.
It's free.
It is free.
It's free for our club. So initially we are
Because we're a
not
model
a
club?
model club.
Because
Yes,
it's
we
a model
ask
club?
yes, we ask for the status to be model club so that we don't need to pay fees.
Oh, okay, so we don't have to worry about that. Okay,
We don't need to worry about it.
okay, all right. I think your proposal makes perfect sense.
Okay.
Now,
Sounds
I don't necessarily think that needs to be something that goes up to a vote. I think we can just agree
No.
to that.
Okay.
Yeah.
Okay, perfect.
Yes.
Okay.
Oh, do we need to vote? I don't think so. Do we?
I don't.
No,
You just manage
No.
it. You tell.
Oh, you manage it. Yeah, no, it's. I think it's.
I managed. Yeah.
Yeah.
I'll do.
Then we're not changing how much the dues are or status or anything like that. It's just literally how payment is being made. So I think that's
Right.
Oh,
totally.
and for the next item, the agenda, John, I looked it up in the Articles of Agreement, and it's the Vice President. Does-
Okay. Well, we just got to communicate with the president because the
Yeah.
president presides over the
No.
meetings. Just got to communicate what's going on.
Yeah. So I know, John. My apologies to you for that. I know we were doing it for a few months where I was preparing it as well. So there might have been some confusion about that, and I know I wasn't really available the last while. I'm kind of back on the wagon. So, but yeah, I'm happy to help do it. I can do it, whatever you prefer. But
Yeah, I'll do it, but I'll just talk to you about what's going on this next coming month and so on and so forth. Yeah, what to
sounds
expect.
good.
Yep.
Appreciate it.
Okay.
And then the other issue, stock study guide, we still have. Well, I think we have a few spots missing, but I mean, I think that's a moot point at this point here.
Do you have any new members coming up? They're going to join potentially next month.
No, not yet.
Okay, well then we're going to have to sell if we recommend to buy for the stock study. You know what I'm saying?
Yeah.
Oh.
So, Jane, did you
Well,
hear?
I mean,
Jane, Island,
Yeah.
Chris, if you propose
Christopher.
stock, we're going to try to be strict about this. If you propose a stock to buy, then you also have to propose a stock to sell, because we only want to have one stock, one member.
Yep. Okay.
Okay.
Okay,
I wanted to say also I'm going to be contacting people for education topics. As far as I know, there's nothing beyond Kimberly in July. So I mean, it could be 5 or 10 minute if you want to do something. 5 to 10 minutes, you want to do something simple, like I did with the book report I made. You know,
Right.
you can do something simple, or you can do something more complex like Jane's tonight. Whatever you're interested in, feel free to propose it. I'm going to contact a lot of people that haven't done an education topic in a while over email. So, yeah.
perfect. Appreciate it. That's good.
Thank you. Is that it?
I mean, I think that's everything that's on the list. Is there anything else that needs to be urgently raised?
When is our next? I could ask this later. Actually, never mind. We should end.
Okay, I'm going to end the recording.
Yeah.
Was meeting adjourned?
Meeting's adjourned, I think.